Hi, I'm Matt McAleer, President and Director of Private Wealth, joined by John Mousseau, Chief Investment Officer at Cumberland Advisors in Sarasota, Florida. Today we will be discussing our thoughts on the fourth quarter of 24 and how the action in both the equity and fixed income markets affected the Cumberland strategies over this time. First is a broad comment. It was growth over value all year long.
Just kept coming.
If you weren't mega overweight growth, it was a tricky year to keep up with the NASDAQ 100 or the S&P 500. Those areas performed well in our portfolio. We're a little more diversified, and some of where we diversified ended up being a laggard. Let's take a look at some of our strategies. We're going to start with our broad equity strategies. Then we'll move over to John in fixed income, and we'll finish up with our thematic strategies. First, our U.S. core strategy. Strong outperformance from Vanguard Growth ETF, VUG. Heavy consumer discretionary, heavy technology, very strong, added wonderful performance. Where did we lag? We have a position in RSP. That's the equal weighted S&P 500. You might note that the S&P 500 cap weighted outperformed the equal weighted, John, almost 2-1.
Wow.
Really such an outlier that you have to start to think going forward, some of that outperformance may see a reversion to the mean.
Absolutely.
But I'll tell you what, that's not the way to play it yet.
No.
We'll keep RSP, but not adding to it at this point. In terms of our international equity ETF, that's non-US. 2 steps forward, 1 step back in the international equity markets. As we mention and even joke around a little bit, international hasn't been able to keep pace with the US for 15 years.
Right.
So it's a strategy we use as a diversifier. Some countries had outstanding Q4 performance and 2024 performance. We had a wonderful smaller position in Argentina, had an outstanding Q4. What was a laggard? Where were we lagging most of the year? A lot of trouble, believe it or not, in South Korea, a very advanced economy, very infotech driven, but having political trouble. And that can always be the wild card.
Political buzzsaws, you don't see them coming, which is why they're buzzsaws.
We're trying within international to get some leverage to the tech markets. Difficult to do internationally because they're not a tech-centric area, Europe. Right. Asia is, but not much in Latin America. I mention that because 2 of our overweights are Taiwan, and we're trying to get to Taiwan Semi. It's a 20% holding in that right. ETF. And also, John, the Netherlands. Believe it or not, ASML, a powerhouse in the semi-equipment business, is located in the Netherlands. It's a 23% holding of Netherlands. So we're hopeful.
And very important, too.
Oh, the industry doesn't go on
without it.
NVIDIA or ex-NVIDIA doesn't go on without ASML and Taiwan Semi. So I feel they may be helpful to us going into 25. Very quickly, our active passive strategy. What is it? It's a balanced strategy. John's team handles bonds. On the equity side, it's passive. 2/3 S&P 500, 1/3 mid-cap 400. Very solid year. S&P outperformed mid-cap, but for the first time in a while, mid-cap got its feet under it and put a decent return together. That's a nice foundation account that we use for clients. So that's a quick view of our broad strategies. Let's get over to Moose on fixed income.
And bonds, really the fourth quarter and really last third of the year dominated by the election. We have a couple of charts up. One is courtesy of our friends at Bianco Research, and what it does is it correlates the betting odds of Donald Trump in the betting markets, and it puts an overlay of the 10-year bond yield, and it takes you back to the summer. Soon as Biden left the race, Harris joined the race, the polls narrowed, and you can see his betting odds were dropping, and that 10-year bond yield dropped down from about almost a 440, and it went all the way until you got to the middle of September. And what do we know happened in the middle of September? The Fed finally cut rates, and they cut them 50 basis points, the first of what's expected to be more cuts, but it was 50. And since then, all you've seen is a rise in long bond yields.
Right.
And you can see it correlates on the way back up with the Trump betting odds going higher. And we know not only did Republicans win the Senate and the House, and of course the White House, but that backdrop created the sense that maybe we're going to get more spending, perhaps more inflation than we bargained for. And they were kind of hearkening back to the 2016 election when you did see yields rise after Trump got elected.
Right.
The second chart here shows basically the 10-year AAA muni yield and basically the 10-year Treasury yield from the beginning of the quarter right to where we are now. And it's instructive when you look at it that you have seen yields rise. 10-year Treasury yield is up 84 basis points basically since the beginning of the quarter. The 10-year muni yield, AAA yield, is only up 46 basis points. Right. And you say to yourself, why? Well, the reason is that you had very little supply in the fourth quarter. A lot of smart municipal issuers front-loaded their issuance, got ahead of the election. So as yields were rising during the quarter, the amount of municipal supply out there was less and less on the new issue basis. So that really helped the relative municipal bond performance as we got to where we are now. And you can see that in this chart. I think one of the things that's really important to keep in mind, though, is what is the attractiveness of bonds now, generally, versus where we were? And when you look at it on a real basis, in other words, after inflation, we think it's very attractive. And it's easy to go back to the end of last year. Where were you at the end of last year? You had a 390, almost a 390 10-year Treasury, and you had trailing 12-month inflation that was around 2.5. Here you are now. The 10-year bond is at a 460. And that trailing inflation, whereas it's a touch higher at 270, because we've had some bouncing around, that is a real yield of 190. And if you look at some other inflation numbers, even higher than that. So there's no question that financial conditions are somewhat tighter, and we believe that bonds are more attractive.
Well, listen, bonds act as an income vehicle and a ballast to an overall investment portfolio. As you mentioned, if we're 200 basis points or 2 points spread from income to inflation, they're
Right.
doing their job. When
Exactly.
we talk about real return, we're talking about income, cash flow versus inflation.
Exactly.
Great. Let's focus for just a couple of minutes on our thematic strategies. We have two that we use to complement our broader foundational type allocations. The first is our U.S. equity ETF. In that strategy, we do own some index exposure, but we try to leverage the performance through focusing on industries and sectors that can create some alpha,
Right.
some outperformance. Our strength, again, landed in the growth and technology area. Our largest holding in there is SPYG, S-P-Y-G, which is the growth area of the S&P 500. Had a 20%, nearly 20% holding. It really performed well. Where did we suffer, or where were we behind the eight ball? You know, it's been 3 years now, John. Healthcare can't lift its head up.
Nope.
It doesn't matter if it's the drug companies, the medical device companies, biotech, the health insurers. That's been a drag on performance.
Been running on a treadmill compared to everything
It
else.
sure has, and we'll look to stay flexible with that. We haven't added to it, and we have cut back to it. It may have to be trimmed even further. Tactical trend is our other thematic strategy. What makes tactical trend a little bit different, John, is it can own individual
Right.
securities. And some of those got quite volatile in Q4. As a matter of fact, Tactical was having a heck of a run till the middle of December. We had a couple of our names, Vertex Pharmaceuticals, halfway miss on a trial and pull back about 10%. Then we had two of our larger names kind of running in mud. That's Berkshire Hathaway and Microsoft. Nice to see them get a bid, specifically Microsoft, here at the turn of 25. But that was a little bit of a heavy lag on Tactical going into December. Overall, solid year ahead of the benchmark there. In terms of 25, I think we're going to keep one thing in mind. New administration, as you mentioned, pros, cons, fears, greed, everything goes with that. I say to our traders, currently, we don't want to look too far beyond our headlights.
No.
You've heard me say that before. We'll continue to be flexible. We'll continue to try to find reasonable entries. That's it on my side. Any last thoughts, John?
Just that, you sit here and you say, it's been a long, strange trip given the political landscape out there. Bond yields are a heck of a lot higher than they were, so you have to think that as you go into this, you've got a good income stream in both munis and treasuries and other taxable bonds. So we're looking forward to a good year.
Great, John. Appreciate it. Thank you for joining us for our Q4 24 review. We hope you've enjoyed it. We look forward to providing you with more content on the markets and on Cumberland Advisors investment strategies. We'll do this on a quarterly basis. Feel free to reach out with any questions and make sure to visit our YouTube channel where you can find other relevant content such as our weekend review. John and I do that every Friday, and our strategy profiles.